Hey folks, welcome to Pro Trader Strategies. I'm Eric Wilkinson and we are an educational company. So if you guys want to learn about trading and options, you've come to the right place. First place to get your edge is right here with education, folks. Before you go, smash that like button. I like to think of it as when you smash that like button, it's like you're throwing those little bots or those crawlers in the interweb a bone. And what they do is they run out and they perform a trick for us all. And that's really going out and finding a person just like you. So please hit that like button, throw that cookie to the bot so it can get on its way. Also, throughout this video, comment down there at the bottom. I'm going to make sure you folks are clear of concept before I move on. So without further ado, let's get on with it. We are doing swing trades with options. Well, why swing trades? Well, swing trades are a great way to find a change in momentum in the markets. That's the opportunity to take advantage of a quick move in a direction. Further, with those swing options, those swing trades, I should say, that gives us great strike location because we can find it at a support or a resistance area that we know there's going to be some overhead selling pressures or under, I don't know what the word I'm looking for is, but basically buying pressure near the low ends. All right. So that's what we're looking for in a swing trade to try and get the, turn the tables in our favor as to directionality. And then further, we're going to use option because that gives us even better strike location. And that really turns the probabilities of success in our favor. So when you're trading with a stock or ETF, really you're beholden to those market moves, where with options, we can pick a certain environment where we use different strategies to either take advantage of volatility or exploit it for that matter. All right. So without further ado, let's get on with it. But like I said, make sure you hit that subscribe button also. And there's a little bell down there at the bottom. I do spot the trades every morning. Those aren't always like exactly at the right time. When I find the trade, that's when I'm going to come on and talk to you folks about it. So if you have that notification, you guys will know exactly where I am popping on. All right. So the notification and further that little bell. All right. That's it, or subscribe and the bell. All right, so swings trades using options. We've done the bullish moves. We've done the bearish moves. Now we're looking at sideways moves. And usually when we're trading stocks, especially and ETFs, a sideways move is one of the ones that just makes you want to pull your hair out because, you know, you're thinking I could have gotten in and out like 10 or 11 times and made some money there on this underlying. Well, with the options, we can actually do that and never really have the angst of being right as soon as we hit that click, because that's what happens when you're buying a stock for a bullish move. You buy that stock, it goes against you. All of a sudden, you think you did something wrong. The beauty in options is because our strike locations aren't really that close, that doesn't really go through our mindset like that. So that will also keep you mechanical. And something I talk about with trading, take the emotion out of trading, folks. If you're thinking about, I need to make this much money or I'm down this much money on a trade, that is where everything breaks down. You become emotional and you don't start thinking clearly. If you can look at it as probabilities and stay mechanical, you will be much more successful. I can assure you of that. That's the one thing I can assure you of. So by the end of all of this, I hope that I can get you folks to a place where options just make sense. My goal is to get you folks to where you actually understand options intuitively, and I think I can do that for you quickly. All right, so I kind of mentioned the fact that we are going to forget to share my screen probably. There we go. So we're using swing trades with options, all right? And with that, in this particular video, we're going to actually be talking about the short strangle. But I don't want you necessarily to go into the mindset of, hey, we're doing a short strangle today. I got to find an opportunity for it. No, what we're doing is we'll ultimately come to the idea that we need a short strangle for this strategy, okay? I don't go into a day thinking, hey, you know what? I haven't put on a strangle today. Well, that's because that's not how it works, right? What we do is we look for opportunities in the market. And once we find that opportunity, then we need to start figuring out how to find the option strategy. And I'll show you how to do that here. But first, let's talk about these swing trades. And when we're talking about swing trades, some of you might be thinking, what the heck is a swing trade? What does that mean? Really, all a swing trade is you're trying to take advantage of a shift in that momentum, all right? So if you are talking with a bullish move, so this, whoops, I forgot to change it to my pen. That would be a bullish move. All right, let me get to my pen here. So swing trades. Ultimately, what we need to do is go through a three-step process. Ultimately, you need to look at the overall trend. So you're looking at a picture of, say, a year or whatever your time frame is. You look at the entire screen and kind of get a gauge of where this thing is going. Is it bullish, kind of like this would be a bull look if it was continuing to move higher, right? Bullish, market neutral, which is what we're going to be talking about today, and bearish, going where the market is moving down, right? The next thing we have to do is find some support and resistances, all right? So what we do is we look at what the underlying is doing and find out where it loses that momentum to the upside and finds the buyer or support on the downside. And you can see that happen with the market neutral as well, or say a bear move as well, okay? So we're going to try and find all of those kind of things. The next thing we do is find the resistance, the support. So you find the overall trend. The next thing to do is to find the support and resistances by what this underlying's been doing. And finally, what we're going to want to do is base this trade off of our pattern. So this would be the pattern, a bull pattern within a bull trend, right? We've got a bear pattern within a bear trend. This would be the bear pattern. This is the change in momentum. That is what we're looking for in that pattern within it, okay? So market neutral, bullish pattern, all right? So first step, find the trend, look for those support and resistances. The best way to really do it is kind of blur your eyes, folks, or you could use some Fibonacci's, things like that. But, you know, if you're looking at a trend channel or something like that, really the best way to do is kind of blur your eyes and draw your line so it hits as many of those tops and bottoms as you can on the move, all right? Is the easy, now people that are like chartists and I don't know, may have some kind of charting degree, you know, it's all about reading the tea leaves anyway, folks, but they might say you need to hit the wicks. Someone will say you need to hit the bases. Ultimately, hit as many of those as you can is what it comes down to. All right. So for instance, in this one, we have why won't my pen stay on there when does it change? I've got new software here, folks. So it's all kind of touch and go here. So we've got a bull trend, right? We can see that as a bull trend. And then I got to figure out how I can erase that a little bit. Let me try and, I went a little far. Bear with me, folks. So we got a bull trend going, right? And we can see that the underlying kind of does this, right? But we're looking for it to kind of bang on support, right? And resistance. So, you know, you would initiate your sell on a resistance or a buy on the support levels, right? Is ultimately the idea here. So we found the support resistance. In this one, I would say that this was turning into a bull pattern, right? In a bull trend, okay? So you can see that this corrected and started moving higher there, all right? Does that make sense to everybody? Feel free to comment over at the side if you have any questions, comments. Somebody else probably has that same question, so please do not hold back. Even if you might know the answer and think, hey, you know what? He said something here that might confuse some people. Please throw it out there. I'll be happy to make sure I review that, all right? And make sure you feed those bots, get those crawlers crawling. Hit the like button there. All right, so bull pattern within a bull trend in this example. Here we have what? It looks like a pretty, oh God, it's going to make me do this every single time. We've got a market neutral overall trend, right? That we could all say that. And then what you want to do again is blur your eyes. What's this underlying doing? It's kind of going like that and right? So we can then find our resistance. I'm not even following those lines necessarily. Actually, I'd say that this would probably be for an aggressive trader, and maybe down here would be somebody who is a lower risk tolerant person. Okay. So, for me to tell you which lines to look at, there's a couple of different ones here, because we can see that with this one, that there are definitely a couple of areas where we could say that this could be actually a resistance area. This is, for people that may have a lower risk tolerant level, and a support level here, and then another one way down here, right? So it's not always exactly the same thing. That's why I said it earlier, it is a lot about reading tea leaves here. But if you are more of an aggressive trade or higher risk tolerant, I would go with the ones where it hits the most there. All right. Yes, it's going to cause sometimes to go through, but we can't avoid that. We have to play the probabilities. We know that more and more times that we do this, the probabilities are going to play out in our favor. So in this case, we have our market neutral, and I would say a bearish pattern within a market neutral trend. Okay. So we could take advantage of something like that, moving back down towards the point of control or something. Sorry, I went a little far. Oh, that was my market neutral. And then obviously we have I got to switch the pin every time with the new software. All right. So we've got a bearish. Can we agree that we have a bearish overall trend here, right? And then we can kind of draw our lines for resistance, kind of find some supports, just try and hit as many as you can. And then, we could say that we've got a bullish pattern within a bear trend, right? So you could take advantage of that. Now, the idea would be to get out for, if you have a lower risk tolerant nature, then get out when it hits back towards that mid area. Right in the middle is the idea to get out of that for a lower risk tolerant person. Somebody that has a higher risk tolerance is going to probably wait for it to come up and test that resistance band, okay, on something like this. So just a little bit of review. Find the trend, support and resistance, and ultimately we are basing our trade off of the pattern, okay? Because you can have a bearish trend and a bullish pattern. We're going to have a bullish play and a bearish trend. It can happen. Take advantage of it. There's always a bull and a bear market somewhere. All right, but we need to be prepared, because sometimes, like we talked about this, we would be looking at this coming up and testing that resistance area. And Wolfman, you forgot to change the pin every single time. Somebody remind me, you see that slide switch? Somebody throw over there in the comment box, use your pin. All right. So I would be looking at this as, we've got the same thing, market neutral, but this I'm going to be looking for. Swing trade, something to talk about real quick. We're looking for big dojis, like we call this like a hammer doji, where the bottom of the base is all the way filled in, a spinning top doji, where it's got a little bit of that wick, but more of a long wick at the top there. You could see one that looked like a hangman doji, something like that. Those are at the top and bottom of the moves, not patterned together, but just looking for those simple patterns there. The other thing that we could do is see these in, say, for instance, green. It could be at the top or a bottom of the move at green. They could be green like this, okay? At the top of the bottom of a move, all right? It doesn't matter. This one could have been a green candle looking like this, and it would have been the same type of setup, okay? So I would look at this as turning into a bearish pattern in a neutral trend, okay? And we would take advantage of it. Maybe it's going to depend on our premiums as to whether we're buying option strategies or selling option strategies. So by looking at just this, all I can tell you is that I would want to be negative deltas or bearish, okay? And I'll talk about negative deltas here in a minute. Don't run away. I'm not done. I'll explain that. All right, but this happens, especially if you don't wait for it to get confirmed. All right. If you don't wait for it to get confirmed, somehow on that switch of the slide, it came back to the pen. If you are an aggressive trader, like myself, I would be setting it up likely on that candle we just talked about previously. If you are newer to trading, especially swing trades based on patterns and stuff like that, on a pattern like that where you had that doji, you would want to wait for the next day to have a red candle finish out below this low there, okay? So this candle would be a confirmation of the underlying turning bearish. What did we get over here? It was a green candle. It broke the pattern. It's not confirmed. Now, I don't have a problem with you getting in there when you see the candle and before the confirmation, because that's what I do. I like to get in there early. But if you have a lower risk tolerance, wait for that candle to do something like that. That would be the confirmation of a rollover. All right. If you don't, you want to get out when that underlying looks to settle above that wick. All right. If it settles above your previous day's wick, like above here, in this case, the underlying was a green candle, right? And it decided to make that move to the upside, like this ended up turning into a green candle and rallied up and then finished above that level. Then that has broken the pattern and is looking bullish. Okay. So that would be good afternoon, stock indices. So those are kind of things we're looking for. In this case, this pattern was broken. Had you gotten involved in on this trade, this would be your out. You would say, I'm out of this trade. It's broken the pattern. A swing trade is not happening, okay? And in this case, that's where you would look to get out, all right? If you have a low risk tolerant nature. In this case, actually, before when this happened, we were selling calls up here at this level. So yes, it did come up here and get very, very close to our short calls, but the market ended up rolling over again when we saw this pattern, and I stayed with it. But I got hit on this, bang, bang. I was like, all right, it's already, I'm kind of married to it at this point. We're just going to have to see if it tests me. And it ended up rolling back over as an example in the class. So just as a review, first, what do? See if my pen's working. I guess I have to touch it or something. Overall trend, right? Are we bullish, market neutral, or are we going to be switch the pen to red, bearish, right? And then we want to identify those support and resistances. So basically we kind of are looking for something like that, right? And do that again and again and again, depending on where we're looking at it. And then the pattern within the overall trend. In this case, we could be looking at a bull pattern there, and a bear, okay? So trend, blur your eyes, find those support and resistance. Where do the buyers come in? Where do the sellers come in? All right? And then find the pattern. Where's that momentum shifting to? How are we getting to where we're going? All right? All right, no, that doesn't want to shift. There we go. All right. Now, why do we want to use options? We have better odds. Better odds, right? Lower margins. If you're out there buying it with stock, folks, you guys are putting up a lot of margin in order to trade those stocks. All right. And you're going to have less risk. Even with this strategy where I'm naked on this strategy, you are going to have less risk than you would otherwise. Why? Because my strike location is in such a good spot. Remember, when you're doing the stock and ETF or future, you are beholden to the market move as soon as it is placed, as soon as your trade's placed, right? If I do it with an option strategy and my strike location is this far away from where the underlying is trading, I've got a lot of room to be wrong, all right? I don't know where I was going with this one, but I think I got ahead of myself here. This was where we were talking about selling calls up at this level on this pattern setup, and the market shot up, blew right through me. If I was in stock, I would have been like freaking out probably as soon as it got above this 132 area. I had two areas of resistance, right? I mean, we can look at Fibonacci's as support and resistance as well. So I could see that I had two resistances. It blew through one, but then that means it's likely going to get hung up on that extended fib there, which it did. So the market came back. I'm not saying this was a massive winner, folks, but it wasn't a loser, all right? So it was basically a scratch. Might have been able to get out as a scratch with the stock or ETF, but highly unlikely because you're waiting for it to break that pattern in that case, or the previous candle. But something beautiful with IBM. I've been trading IBM since I was in college, folks. Why? Because it is so friggin' boring. I bought it because I thought IBM could change the world back in the 80s. Remember, they were the ones that came up with that VGA hookup that I've been blasting off about during the Spot the Trades videos during the week. Nobody uses VGA anymore, but I've been trading IBM since they came out with that. And folks, they really haven't gone anywhere. It was trading right around 100 back then. So the beauty in IBM is, yes, it has switched up to another paradigm there, or another level. Let's see if I do this again. That's what does it, I guess. I can see my pin now. So now, you could easily get involved in this as this being support. Something we know about swing trades is as this acted as resistance on the way up. If you blow through that, that's where your support is going to be. So look for that now to be the support. And that's showing through here in the IBM. So yes, you did have one bad trade maybe in here where it blew up to that level and it kind of popped you out, but you could see throughout time, you would be getting in and out of these. The probabilities will every once in a while come true, and it's going to be a losing trade, folks, but you got to play the probabilities because the probabilities are the probabilities. And in this case, there's several opportunities. If I was getting involved in IBM, I would be looking at those as my support and resistances now. So yes, it will sometimes break through the support and resistance. I will get the hang of this. There, I guess I got to touch and release. It will break through sometimes, all right, on those supports. Something to do, though, when we're talking about a swing trade, right? You're not basing it necessarily as soon as it touches. You want to wait for something like this where you got the confirmation again, right? Especially if you're a newer trader or it breaks back into the trend channel. In this case, we were taking this long position every time. And would want to normally cover it when it hits those that mid mark, all right? Hasn't been able to reach up there to that top mark, but I've been playing this along that bottom trend channel, and it's working out quite nicely. And another thing is, why options? In a situation like this where it comes down and touches a 50-day, maybe it doesn't come and touch that support line, well, you could still be taking advantage of this type of trade there with the volatility or something, right? Because the volatility had spiked up there, you would have a good strike location. And I'll talk more about those volatility things a little bit more. I just kind of tease you with some of those options here. So by the time we get there, you guys will probably have a good understanding. All right, so XLU is the trade that I'm looking for. Is it profitable to sell premium on low price stocks? Yes, that's a great question. It is only profitable to sell premium, though, and I don't care what the price of stock is when the volatility is high, right? We all have to be good stewards of our capital. And in that, when we're trading options especially, we want to buy options when they're cheap and sell them when they're expensive. Now, you might be asking, how do you do that? Well, we're not to that section yet. So make sure you stick along. We will drill into that. And if you got to take off before you go, smash that like button and feed those bots, all right? Or comment over to the sides. I mean, stock indices is all over me. We'll talk about this here in a second, though. I'll get to it. I promise. All right. So this is the one that I'm looking at here. It's XLU. It is the utilities ETF. All right. And basically it's, you know, it's things like Exelon. There's a couple other ones in there. Basically, Dominion. There's a lot of names in there. They're pretty decent stocks, but not a lot of people trade those. And they're pretty boring, to be quite honest. And that's why. Having said that, what we can see happen with this trade, am I going to get my pin here? You going to give me my pin? No, it's not. It's just a teaser. It's like every once in a while. All right. So what we see here is that we get these moves in XLU, and then we get a sideways trend a lot of time, or a downward move, and then it kind of calms down a little bit here and trends sideways. Big move, right? Trend sideways, calm down, big move. What am I expecting? I've kind of got my support and resistances. Actually, I've got a different chart here that I'll show you here in a second. The resistance is actually way up here. Let me get one with a Fibonacci on it. Because I can't throw a Fibonacci on here. Let's see. Here we go. Let me pull this down. There we go. Let me stretch this down. There we go. All right. So this is a Fibonacci. It's basically based on the 3-year here. Okay. So this is going back to the high pre-pandemic. All right. And it's actually the high and low of the pandemic. So with that said, I've got an overhead resistance here. This did blast off a little bit towards the end of the day. If you look at my charts throughout the day while I was looking at this, I had a bit of a different picture. It was looking like a pattern that was going to start rolling over, but I'm going to go with it anyway. So with that said, I can see there's a support here at 65 because that's a Fibonacci. 50-day simple moving averages will act as support and resistances. And this little value area high here might as well act as a support area. So support and resistance is all over the place. So with that said, I'm looking at it like we can take advantage of a sideways trend here because it's made that big move. I think it's going to calm down. It doesn't usually make incremental massive move higher throughout this time. So Eric, just remembered in regards of the monthly subscription you had a few weeks ago. Where can I access it? As a matter of fact, I think you're talking about that link right there. Is that what you're looking for? I threw that down there in the chat window. I think that's the one you're talking about, right? Otherwise, you'll just pick up the phone, give me a call. All right. So I'm still going with my assumption based on this market neutral trend. Yeah, it's kind of getting a little overextended. I might pick different strikes tomorrow than the ones I was picking during the middle of the day, but the strike location on it I kind of like, so I'm probably staying with it at this point anyway. All right, so before we get too deep into this strategy, I do want to talk a little bit about this, the options and what are they. So a call option gives the buyer the right but not the obligation. And that's the key, not the obligation. It means I can, but I don't have to, right? To buy the stock. So if I buy a call, I have to pay out, dollars. I don't get those dollars back, all right? Those dollars are gone if I pay for it. But by paying for that, I have the right to buy the stock at my strike price. So if we're looking at XYZ stock, let's just say is trading $100, okay? And I buy, let's just say I buy a call up here at the 105 level. Can I make that into a 105? At the 105, I buy a 105 call. So I pay, let's just say $1 for that. That dollar's gone. That gives me the right, but not the obligation, to buy the stock XYZ at 105. It's trading 100. Do I want to go through my right, or exercise my right to buy the stock at 105 when it's trading 100? No, right? I can simply go out and buy it for 100. Yeah, I did pay $1 for that strike, but so what? I can buy it $5 cheaper, right? But if this underlying then during the life of this contract that I bought shoots up, it's now trading 195, is my 105 strike valuable? It's immensely valuable. I can buy this underlying at 105, it's trading 195. I have made $90 in that trade, guaranteed. All right, because my option, if it's up at 195, if XYZ moves up to 195, right, this stock or this strike has to include the benefit of owning the stock. All right, meaning I have to, this option that I bought at 105 has to be at least, if not more valuable than that $90, right? Because the 105 strike has to reflect the value from 105 to 195 forever, or at least where if it went out there, you know what I'm saying? It can never be worth less than that $95 or $90, I should say. Should not be less. It has to include the benefit, the difference there, all right? And there's going to be extra on top of it. We're going to talk about theta and all of these other things. Even going into the last day, you're going to see a little bit of money maybe left there on the table, all right? So you never really want to go through the assignment. If this was trading 195 and I was long the 105 calls, especially in this day and age, because going out and buying stock doesn't cost you anything. The assignment process, the cost of that is actually pretty expensive, all right? So rather than do that, get out of the option, sell the option, you'll get that, it'll include that benefit, that distance, plus a little bit more. That's why, another reason why you don't want to go through the assignment process, because it's going to cost you the money for the assignment process, and you probably be leaving money on the table. I'll show you that when we look at the option montage, how that works. And I'll show you a quick way to figure out how much is in there. And if you want to learn those kind of things, make sure you're smashing that like button and feeding those bots, all right? Comment over at the side. Let me know what you guys are thinking. And then the option seller, the call seller in this case, though, has the obligation to deliver the stock. I mean, I have to give my stock away. Now, you might think, oh, that doesn't make a whole lot of sense. Well, I get to keep that dollar. So if I sold this guy that 105 strike, I get to keep that dollar, all right? That dollar is mine. It goes to me. But if it goes up to 195 and I have to give him my stock at 105, yes, I did lose that participation, all right, on that upside. I got to keep the dollar. Now, if it goes down, if the underlying, I sold that call and it goes down, then I had never had anything to worry about. I just got a free collection of credit, right? Now, the put buyer has the right, but not the obligation to sell the stock. So if I buy a put, you can think of it as insurance for the downside. If I buy a put, that means I have the right to give you my stock. You have to buy it from me at whatever level, all right? And the seller of the put has to buy the stock at that level or take delivery, you can think of it, all right? So when you're selling puts, if you ever sell puts, just know, hey, I'm willing to get long here, all right? Or if you're short calls, you're thinking, I'm willing to get out of my stock or get short here, all right? Did I say that right with the puts? Trying to think how I said the puts because it sounded like it said the same thing. The seller of the puts has the obligation to buy it, right? He has to take delivery. All right. So we've talked a lot about options, buying and selling. We've also talked about there's premiums in there, right? There's $1 here, there. Well, every strike has an associated premium, all right? And what we need to do is look at that premium and determine whether or not it is expensive or cheap, right? Pretty simple. We're good stewards of our capital. We need to find that. The only way to do that is to look at a couple of different places. Now, I don't know what everybody's platform is, but you should have a place in your platform where you see Vega. All right. This is Vega for the puts. And over here on the calls, we have a Vega also. And it runs all the way down. All right. It's all the way down in that column on the calls and the puts. Disregard that. That's because the pricing is so screwed up. So the Vega, what it tells us, like all of the Greeks, they give us an indication as to what happens to our premiums with a increase or an advancement. Okay, so you can think of it as the stock goes up, right? Theta is the thief in the night. Theta is talking about time. It thinks of it as a day goes by. Vega is volatility increases. So delta is based on $1. Theta is based on 1 day. All right. And Vega is based on 1%. Positive across the board. You can't go back in time, so we don't have to worry about that, right? But if the underlying goes down, a negative plus a positive makes it a negative, right? So if the underlying went down by $1, then a negative plus a positive, negative plus a negative delta over here would make that a positive delta, meaning that's a positive to our position. All right. So if the underlying went down, our premiums would increase by that amount on the side. And the put side, if the underlying moves higher, then our premiums decrease by the corresponding delta all the way down in that column. Okay. But right now I want to talk about Vega, and it is implied volatility. All right. Implied volatility you'll see in more places than Vega. They just wanted to come up with some kind of Greek, which actually isn't even a Greek letter. You're not going to hear about the Corona Vega variant. You might hear about the Delta, Gamma, and Theta, but not the Vega. So increase of 1%. So if ours increases from 13.91 to 14.91, all of the premiums would increase by that. All right. So volatility, when it's at extreme highs, we know that those options premiums are expensive. And when Vega is at extreme low, we know that they're really cheap. Now, circling back to Max, I think was talking about, it was stock indices talking about profitability on lower price stocks. This is a lower price stock, right? And you might even be looking at this Vega and going, geez, XLU's Vega is only 17. That's incredibly low. These premiums have got to be incredibly cheap. But you are thinking about maybe volatility for Tesla or something, all right? We need to compare apples to apples. So in that, what I mean is we need to look at XLU's Vega compared to XLU's Vega. I'm not comparing Vega to XLU and Tesla, right? Those are not even in the same realm in this world, all right? So we have to look at each individual's Vega, all right, or implied volatility. And that's all Vega is implied volatility. It's a fancy name for implied volatility. It's a fancy made-up name. All right, so I don't need to, all I know right now is I've got an assumption that we are going to stay within basically this area based on this chart. I'm looking at so all of this I don't need to know for Vega. I need to know what's going on down here. And I've got an implied volatility chart. I don't look at historical volatility. That historical volatility tells us where we are now based on historical volatility. I want to know where implied volatility is based on implied volatility. Why? Because implied volatility is forward looking. Implied volatility is the expectation of future volatility. All right. So that's why I want to look at that. I don't care about where it's been and where it is now. I want to know where they expect it to be versus where they expected it to be. Okay. Because that is forward looking. And in that, we can see that this almost trades like or moves like a swing trade, right? You can see where those support and resistances are. So I need to find out where this data point is in relation to the high and the lows. Okay, so I want to find out where we are within that metric. So I'm going to zoom in here and draw some lines. Now, one of the things I've been talking about for quite some time is I want to take out anything that happened during the pandemic, really. Some people might say we're still in the pandemic, but I don't think we're going to see the kinds of volatility that we saw during the pandemic because we've already kind of been through it. And even if it gets as bad as it was, we've kind of already been through it, right? So I don't think that we'll see those volatility spikes like we saw during the pandemic. Another reason why I kind of believe that is the last time we saw the volatility spike like that was basically 1984, I think it was. Before that was like 1929. All right, so those are the two volatility spikes we can relate the pandemic to, not the financial crisis, not the dot-com boom. All right, so just to put your head in perspective here. So with that, I've talked about discounting this stuff. It's pretty in line with what we are right now, but I have the script that kind of strips that out. Now, I want to find out where this point is, and you can see. If you've watched a few of these, normally for stocks, I say the 50% line above and below that 50% line is really the determining factor for buying and selling options. All right. But with ETFs, what you can see is ETFs have a tendency to really spike out and get a little bit wanky. And it's usually the spikes to the upside. All right. We usually get those crazy spikes in volatility to the upside because of the energy sector and the utilities and all that. But otherwise, they're pretty benign. And ETFs, there's so many baskets of underlyings in there that all of their volatilities, like while one volatility might be spiking, another guy's volatility might be tanking. So those will kind of offset each other and meld it out a little bit. Another reason why a 17 for something like XLU is actually really relatively high. So above 30% is usually what I like to say for ETF. So, 70% up here is the sell zone, and then the 30% down here is the buy zone. All right. So anything above 30% is basically a sell. And in this, if you guys really want to know the devil of the details, you basically take the current implied volatility minus the low. So what we're trying to do is find out where we currently are from the bottom, all right? Where this marker is off of the bottom. And then we take the high minus the low, which is just the range, right? So we're trying to figure out where we are off the bottom and then where that off the bottom is in relation to the entire range is kind of a long way of saying this. So what we have here is the high, I'm going to call this 35. We got this as 16.5, and this one I'm going to say is 6, all right? So we've got the current 16.5 minus the low, which is 6, and then divide that sum by the high minus low, which I think is 30, what did I say, 35 minus 6, right? So we've got, what is that, 10.5 divided by 29, right? Yep. And that gives me like 36-ish, 36 percentile. So that's above 30. That's where we're going to be looking to collect a credit for an ETF. And because this is ETFs, the line in the sand is 30% is what I like to look at. Stocks, we go at above and below 50 percentile. All right. This one has ETFs just have a tendency to not stay extremely volatile for very long at all and really migrate back quickly. So if you want to go through the math, that's how we do it. ETF above 30, we're selling or collecting a credit. So in this case, we could say that the because it's an ETF, we can see that those prices are expensive because they're in the higher range. Something I wanted to show you to even solidify that is, let's go to a monthly chart or a weekly chart here. And you can see I tagged that from the high and low up there, which gives me my resistance area, support area, right? We've got both of those. But something to note with this implied volatility, let me stretch this back out up here. And you can see before the pandemic, you know, the high and the lows, you know, are a little bit, the paradigm in 1919 or 2019 was a little bit lower, right? So I'm expecting us to kind of get closer and closer to normal volatility by 2020, basically 22. I mean, all right. All right, so we want to sell options because I know those premiums are expensive. Another thing I'm thinking is if we start trending sideways, volatility will come out, all right? Usually volatility comes out in slow rallies and in sideways trends, okay? The only time volatility really expands on rallies is on meme stocks and gold. All right, so the next thing we need to talk about, since we're on to, we've talked about Vega, right? Vega is just implied volatility. We can determine now quickly if premiums in the option montage are expensive or cheap, right? Anybody take that away? Is that a light bulb moment for anybody on how to determine when you should be buying an option or selling an option? I'm not saying, you know, you put on an iron condor or a butterfly or any of that stuff. All I'm saying is at this point, when you're looking at an option montage, you can almost immediately, if not sooner, figure out if those premiums in that stock are expensive or cheap. Okay, get a show of hands, anybody over there, right? Comment over there. If it was a light bulb moment, just give me a smash the like button there then, all right? That'll be my indication that you guys picked up on it and you're trying to throw that crawler a biscuit to run out and find somebody else to tell. All right, theta. Theta is the thief in the night. It comes in picture pocket. But the one thing about theta is it's not linear. He doesn't do it evenly. It's not a dollar, a dollar, a dollar, a dollar. Every night, what happens is we can see it's not very aggressive out here in time. As a matter of fact, this will kind of flatten out a little bit. He never goes away, all right? As soon as that option is created, theta gets a light bulb going off and saying, hey, you got to go steal money from this guy. But the closer and closer we get to expiration, especially 35 days to expiration down here, we like to look at it within, I like to say 45 days to expiration is where I like to start implementing selling strategies. If I'm looking at this as a buy zone outside of 70 days, right? And the sell zone is inside of 45 days, all right? So if you're buying options, you want to limit the theta decay. And when you're selling options, you want to exploit it, right? So if you look at something and you say, I've got expensive premiums, what do you want to happen? You want those premiums to go down. Now, you don't always know volatility is going to go down. As a matter of fact, you don't really know if volatility is going to go down at any given time. But you do know theta is going to start increasing, and that will help you out, even if you're directionally wrong. The underlying could start moving against you. I'm not just talking about in this strategy, but any strategy could start moving against you, and you still make money, right? If that volatility starts coming out and the theta starts working in your favor, you can be a complete, what does my kid call it? A slumped. You could be completely slumped and make money on it. Slump means knocked out, I guess, or something. Sleepy. So theta is that thief in the night that comes and steals our premium. Now, I wanted to go to a high dollar stock or ETF in this case, only to really exploit or really exacerbate these different types of moves. You're not going to see it show up as much in the lower dollar stock, back to stock indices, but what we can see is that, in fact, theta is much more aggressive closer to expiration than he is further away. So 149 days to expiration, you come in like 70 days, right? Look what happened to theta. He still doesn't know you're really alive, right? 6 cents to 7 cents, over 80 or 70 days, it increased by 1 penny, okay? Now, from 86 days to 58 days, let's just call it 30 more days goes by, and it's already increased by that 1 penny. So half the time, and we're losing just as much through theta. It's increased another penny, if not a little bit more than a penny. And then these next 30 days, right? Look what happened. This 30 days, during this 30-day time period, which encompasses that 35, 45 days to expiration, it went from 8 or 9 cents to 12 or 13 cents. It increased by 50%. All right. So the other ones were only increasing by less than 10%. And now we've got to jump by 50%. So if you want to take advantage of theta decay, you want to be inside that wheelhouse, that 45 days to expiration, so you can exploit this type of erosion when you're selling premiums. Now, if you're buying options, get outside of 70 days to expiration. Yes, it's a little bit more expensive, but you have to be a good steward of your capital, and you don't want to see those premiums just getting eroded because the underlying is not moving. All right. And in our case with the theta thief, it doesn't show up quite as dramatically, but you can see that my pen still has not caught on. I still have not gotten used to it in this one video. We can see the premiums did not really increase at all. They did, believe me. It's just we're talking about, hundreds or thousands of a penny here. So the rounding error is a little bit suspect here. So we only saw an increase of 0. It probably increased, let's say, a quarter of a penny or something, right? And that's why the rounding doesn't look like it could have rounded up to a penny here and rounded down to a penny there. But during this next 30 days, we can see that theta has increased 100% in this case. So it's doubled. So that you might not be thinking a penny a day is a lot, but in relation to the premium, it is. All right. Because the premium is correlated to the size of the stock too. So in percentage terms, if we're comparing, selling premium in percentage terms, it is really equivalent in probabilities for sure. So I'm leaning towards the short strangle in this one because I've got a neutral assumption, I've got high volatility, and I want to take advantage of that high volatility. I need to sell premium. I want to take advantage of a neutral market assumption. I need to sell basically both sides. Now, if I was worried about one directional move to the downside or a directional move popping to the upside, then I would eliminate one side of this trade, right? I would make it more directional. But in this case, coming into it, my market directional assumption is we're going to trade sideways, okay? So if I believe we're trading sideways, I need to start thinking, I want to sandwich this bad boy. I want to capture it within that. All right. First off, before we get to the strikes, let's understand delta. Delta tells us the rate of change to an option premium, right? That was that dollar increase, and my premium will increase by the number that the delta is representing, okay? So if my delta is 50 and the underlying moves higher by $1, my premiums only increase by 50 cents. They increase by the delta. But on the floor, what we would look at is, am I gonna I'll get it. It'll come to me. I just get ahead of myself. Delta is data, all right? Because it tells us probabilities. In school, if you guys remember, you guys may have had a standard deviation curve where you would grade on it. And, This would be the A's up here, you know, the A's up here and the F's down here, right? At the end of the swing, if you were graded on a curve. Well, it's still the same thing. The idea was only so many people should be A's and so many people should be C's, right? You should have the middle be the C's or whatever. Well, with us, what we're looking at is this could be XYZ again. And what we're thinking of is XYZ has not changed price. Okay, this is the price when we got involved in this underlying. It doesn't matter where it is. And what we're doing is we can see that like a -1 standard deviation right here. We can say this is like, say, the puts, because puts are negative. And 1 standard deviation up here, we'll say, is the calls, okay? So if I add up everything going this way, the 9, the 4, the 1, the blah, 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 we ended up coming up with about 16%, all right? And again, same thing, going that way, we come up with about 16%, which means about, we'll just say 68% or 70% will land right within those lines if we pick those percentages, right? So in this case, I'm looking at a 70% success rate, right? That's the probabilities. The probabilities are the probabilities. I can't change that. That's the probabilities, right? One thing to note, though, with this is a standard deviation curve. Let's just say that this is what a normal standard deviation curve looks like. There's all kinds of them, right? Some of them look funny. Some of them like go like this and go like that, right? Some of them go and kind of drag out like that. Some of them go long like that, right? Some of them go like that, really straight up. Now, what we can do is look at it like a volatility bucket. When it's really way up, that means there's almost no volatility in that bucket. But if it's flattened out, you can think of the volatility bucket as so heavy, it's just squishing the volatility curve down, all right? When that volatility comes out, it snaps back. And that's what we want, because this 1 standard deviation for the same strike, like let's say this is 1 standard deviation down there. Well, this is the same stock with very low volatility. This is 1 standard deviation strike, and this is 1 standard deviation strike. So if this is 100, let's just say the $100 stock, right? To the downside, this could be 95, this could be 105, and this could be, when the huge amounts of volatility, 75 and 125. Okay? So the volatility squishes down that curve, and the probabilities of a wider range start becoming a reality. All right, like it can move this far, is what volatility is saying. Well, if you're selling premiums when they're really expensive, you're taking advantage of those strike locations. And if the volatility comes out, then those probabilities of that move are only here now. My strikes are still out there. All right. So that's what we'd like to see, is that volatility curve snap back up, or the standard deviation curve. Got a little, does that make sense to everybody? How that works? You can think about this as being a bucket. We can say this is a bucket that's half full. All right. If that volatility starts increasing, the volatility or the standard deviation curve flattens. All right. And then our strikes could be way out here. So that's why we want to take advantage of this strategy, the short strangle at high volatility, so I can get my strikes way out here. I don't want to take advantage of when volatility is really small, because that volatility curve looks like that, right? Make sense? All right. All right, now we're on to the strikes. And guess what strikes I'm picking? The 16 delta, that's right. I'm picking the 16 delta so I can switch the slide again. Killing myself. Short strangle. We want to look for the 16-ish delta, all right? That's really where we would like to be. To stock indices point, lower price stocks you know, you don't get that juicy premium. So with this one, you might need to move in just slightly to like around a 20 delta or something, okay? The idea here is I kind of want to come away with around 30 cents on either side at least, right? I'd like to get about a 60-cent credit total is usually what I like to shoot for, all right? If you're going for that 16 delta on a stock lower than $50, you're probably only walking away with $30 because it's going to be 15 and a 15, all right? Cents. Short strangle, we sell a call and we sell a put, right? That's right. We're going to sell the 16 delta call and we're going to be looking to sell the 16 delta put. So in this one, you can see I picked the 14 delta here. There's actually skew to the put side here. And I'll talk about that in a second, how that works out. And the 20 delta up here to try and get that 30 and 30, all right? Now, how we tell skew is make sure you get your pen so you don't switch the page. We can see we're really close to the 70 strike, right? I'm 30 cents away from it or something. I probably should pull up a other one because I think it was really close to 70. But that's 40 cents away from here, all right? These premiums at the 70 strike are definitely have a little bit extra than that 40 cents in there. They're in the money, so they have to remember this one is saying that the 70 put has to at least, if not have more than the benefit. Well, this one has 40 cents, right? Because the 70 strike to, or actually 33 cents. 70 strike to 67 is 33 cents. So it has to at least be that valuable. For instance, this one, the 76 put, how much is this put worth? The 76 strike. Anybody? $6.33, right? Because the difference between the 76 and this is $6.33. Well, you can see the premium is more than that. That's the extrinsic value. That's why I was saying, even though this put is deep in the money, you know, I'm up money. I might say, hey, dude, I want you to take my stock at 76. I'm selling you my stock at 76. Fine. I get the stock at 76. But in that case, I'm leaving a good amount of money on the table. I'm leaving, you know, somewhere between 30 and 40 cents on the table. That's a lot. Are you guys, you know, remember with the contract multiplier, something I haven't mentioned, with options, every one option is equivalent to 100 of that underlying. Just like when we're buying and selling stock, usually they think of it as a 100 lot increment. I'm buying 100 stock, right? Well, that's why they made an option equivalent to 100 of the underlying, okay? So if you convert it, it goes 100 stock come into your portfolio or go away, all right? So in that case, when I'm saying 30 or 40 cents you're leaving on the table, some of you guys might not be thinking that's very much. Multiply that by 100 and you got $30 or $40, right? You're leaving on the table. So, yeah, if you've ever gone through that assignment process, you probably know that it cost you that $40 just to go through the assignment process. And now on top of it, you left another $40 on the table. I mean, you're down $100 before you even did anything. Who wants that? Nobody. I mean, right? Light bulb moment. Feed those bots. Smash that like button. All right, so trying to collect that. Now, if we go back to the chart, the reason why I love this is look at the strikes, 72 and 65. Well, that 72, actually, let me pull up the other chart. At 72 and 65, look at that. That 72 is above this here, and my 65 is down here at this support level. So I've sandwiched my strikes outside of that. Well, the 65 is right there. But one thing I'll talk about here in a second is my break evens are way outside of that. Because when we collect a credit, we get to keep that. And that increases our break even. So in this case, I went a little bit outside of that 14 and went a little bit inside to the 20 there. Oh, and let's talk about, and I talked about the skew, right? I did go over that. The skew is to the put side. So we could see this one look like that. Okay. Actually, that's the call skew. Put skew will look like that because the strike is further away. Right? This equal distance, if I'm looking at from 70 to 68, that's $2, right? The $2 put is 89 cents. If I go from 70 to $2 higher, it's only 30 cents. Okay? And it's not right on 70, so it is off a little bit, but it's only 40 cents. And if I'm looking at 40 cents on a delta scale, that's only about 5 or 10 cents, okay, that it should be affecting that differently. We can see it's off by 50 cents. So there is skew to the put side. Does that make sense for anybody? We can work these strikes based on expected move also. Well, yes. So the delta, the delta tells us basically an expected move in a sense, because the probabilities, like if this volatility, for instance, jacked up to say 28, all right, so 10 percentage point moves, this would probably be something like a 30 delta. And, somewhere out here, maybe the 61 is now the 16 delta. Okay? Does that make sense? Because delta really is, yes, it tells you the rate of change to your option. That's what everybody says. But it also is the probability of the strike being in the money. So as volatility spikes, that tells us that there is an expected larger range than what was previously expected. As volatility goes higher, all that's saying is that the range, plus or minus, we don't know, is just getting wider. Okay? So we want to take advantage of it when we see that the expected range is at the widest it's been, really, right? So we want to take advantage of that when, we used to say, you've probably heard this before, when there's blood in the water, you go fishing, or chum in the water, you go fishing. This is the same idea, is when there's blood in the water or everybody else is panicking, that's the time to have your wits about you. Because everybody, especially these days, I see it more and more these days with people that are trading options that really don't understand options very well. They're buying options with this extreme high volatility because they're seeking volatility, but they're not understanding the levers and pulleys of this. All right. So right now, that influx of volatility happens quickly because these guys are all chatting about it, maybe on Reddit or something else. I don't know really if that's necessarily the case, but you get my gist. They get this frenzy going, and folks go in there and buy calls because they're expecting an upside move. They're paying attention to that volatility and understanding maybe they're doing the wrong option strategy. They could get that up. They could get the move in their direction, but if volatility comes out during that move, they could have lost all their money. All right, so when we're looking at this is just the Analyze tab. I want to make you very acutely aware of the fact that this is an unlimited risk strategy, meaning if it goes to zero, because I'm selling that put, if it goes to zero, I might have to buy the underlying up at that level, all right? Or if I sell a call and it goes to, Google status, then I'm going to lose from that point higher, all right? Stay mechanical with the charts. When it breaks those levels, well, I already showed you my support and resistances. If it breaks one of those levels, I'm going to be out of it, all right? So, yes, this isn't one of those strategies you put on and go to, you go away and forget about forever and you show up just at the end of the option expiration and see what happened. No, you want to keep an eye on this. It breaks a pattern. It breaks that swing trade pattern. Get out of it, all right, for whatever you can, even if it's a scratch. or a loss. The range gets wider. Are you referring to when volatility goes up? Yes. When volatility goes up, that curve smashes out. So, you know, if I'm looking at a regular curve like this, right? Let's just say that this bucket is half full. If I gave a bucket that was completely full, my bell curve might look like that, right? Because it's squishing it down. Same stock, one standard deviation, one standard deviation. Okay? Because delta is the probability of being in the money at expiration. So if the rate, it's just telling you that range is a little bit wider probability. All right. So with this case, that one, I got my pen up there. I think it's 71.1. That's my out. If it goes through the upside, my out on the downside. These are the wrong charts. It's got a bad fib. So I'm going to go with this one. Above here. Let me try and use I'm going to try and use my janky new pin. So here's where I'm looking at. Above this line, I'm out. Below this line, I'm definitely out because that's my 65 strike, right? 71. It's a little tight there, but that's where I'm looking to get out. I've got a nice little volume node building up here, so that's really going to be where I think this thing really settles down. So that's my assumption with this one, but definitely out above that support. If it settles above that, I'm going to be looking to get out, or settles below this, I'm looking to get out. Now, know that when we're collecting this credit, I'm collecting 60 cents. My strike on the call, I'm short a call at the 72 strike. Sorry, that's how I do my sevens. 72 strike and the 65 strike, I'm short a put, right? And I got a credit of, let's just call it 60 cents. So on the puts, my break-even side is the 65 puts minus the 60 cents. So my break even is 64.40. And to the upside, I add it because that collection I get to keep. So my break even to the upside is 72.60. All right. So almost a full $1.50 above my resistance area and about, you know, we can call it 50 cents below my support level, right? So again, you know, if you're in a stock, you're looking at those support and resistances, and that's where you're kind of thinking you need to get out on a break of a pattern and things resistant, breaking a resistance, breaking a support. Well, when you're in a stock, that hurts. If I'm in the options and this is bouncing around in and around there, I don't care. I don't care at all because I've got support and resistance. My break even's outside of that level. All right. That makes sense? But no, there's no catch here. There's no, there's no security blanket. There's no, gosh, why can't I think about it? All I can think of is a trampoline. There's no catch net or whatever. All right. If you are in an IRA and you want it to perform like a naked strangle, then what you're going to do is you're just going to go way out and buy like a 5 delta strike, okay? Or something for about 5 cents, really. You're buying a strike for 5 cents. Now, what will happen is the computer will say, all right, well, he's got defined risk on this. I don't have to worry about it, but please don't hold your breath on that because you do not want to wait for a defined risk strategy that you only paid a nickel for to save you, all right? You want to get out well before that. In a short strangle, don't you want the volatility to collapse? Yes, we want the volatility to collapse on a short strangle. As that volatility collapses, then our premiums will collapse with it. Every 1 percentage point decrease, our premiums will decrease by that corresponding option, right? It would not lose on the trade. The trade would gain value. If you sell something high and buy something, you would not lose money, right? If I sell something for $1 and it goes to 50 cents, what happens? I buy it back for 50 cents. Did I make 50 cents? Yes, right? So if volatility comes out, we saw that if volatility comes out, for every percentage point volatility comes out, our premiums decrease. Right? So we want this volatility to come out and that theta to start being more and more aggressive. Okay? Because we're selling, we're collecting a credit on this. And for newer options traders, I would suggest that you get out at 50% of max profit. So here I'm collecting 60 cents. A newer trader, get out for 30 cents. All right? 50% of max profit for the newer traders, right? And especially if you have a lower risk tolerance, okay? And if it breaks your support and resistance. Another thing you can say, if your premium's doubled, get out of it for a newer trader. So if it goes from 60 cents to $1.20, pull the ripcord on it, retool and die, all right? Look for something else. But definitely if it breaks this, get out for 50% of max profit for the newer traders. You can squeeze it out a little bit longer if you've been trading for a while, but my usual rule of thumb for anybody that's not out of their mind with risk, go for 50% of that max profit. Especially next week, we're going to be talking about the straddle, and there's a little bit more nuances going on with that one. So make sure you guys hit subscribe before you go, and the bell down there so that you guys get notifications when we come on, because I'm not always doing videos announced. I got a set time that I do spotting the trades where I talk about all those trades I'm doing, when, where, and why I'm putting those on in the mornings. But if I spot that trade at 7:30 in the morning or something like that, or actually I'm talking my time, 10:30 in the morning, 11:30 in the morning, well, I'm going to pop on and talk about that trade then, there, and why, because I hate when people talk about trades and cherry pick the good ones, okay? I don't do that. I talk about the trades that I'm looking at right now, and then we go through the process. I'm talking about if this trade goes against me, how I stay mechanical, how I am adding different trades to that to lower my overall cost basis, stay mechanical, all right, and not lose money. So I'm not cherry picking the trades and say, this trade works, 100% of the time for me. You could have made 5,000%. No, that is not me. What I do is I look at this given moment, we put on a trade, and we see how it works out, all right? And I can tell you the probabilities are the probabilities. We are going to win more times than we're going to lose, and we are well ahead of the game by doing that because we're mechanical, all right? That's all I got. Somebody was asking about the offer. Here we go. I think I threw it already over there. I'll throw it in there again for some folks that are catching this a little bit late. Here's a link for our offer. And I think I've got to stop sharing my screen because it's not showing up. There we go. Got to do the same thing with this one as well. All right. This is only $36. If I've saved you any angst whatsoever, or a light bulb went off, I'm guaranteeing you I have saved you $36 in some bad trade by buying volatility when it was high or selling volatility when it was low, right? Or selling an option strategy when it was low, or buying an option when it was extremely expensive. That has saved you 36 cents already. So basically for that 36 cents in option speak, multiply that by your 100 multiple, because each option contract's worth 100 of the underlying. 15 hours of content, well over that. Rising interest rates, we're talking about the Fed, taper tantrum, all of that stuff. So you're going to need to know how to protect that portfolio. You never even look at 50% of is that bond portfolio. Most people, I don't care how young you are, you have bonds in there. If you have somebody as a fiduciary, you need to hedge that risk. Market profile. I showed you guys how to set that up just the other day in the market commentary, spotting the trade. Because my options or my screens all went down, I got a new computer, had to rebuild it. So I did it for you guys in there. You guys want to know how to trade that though now, check out that one. When, where, and why we're trading options. I go into details that I haven't gone into here, a little bit more about the Greeks in that. So click on that link, you get that. Also, this is where it's going to take you. If you have any questions, comments, or anything else, feel free to reach out to us at 310-598-6677. Or you can email us at trading@protraderstrategies.com. But there's even more than what's going on here. And some fun ones like the history of options. I go into that. First guy who came up with an options strategy became a millionaire. Probably a millionaire in the 16th century. Anyway, he became a very wealthy man from Aristotle's book. Anyway, is it beneficial to sell the Strangle before earnings for the volatility collapse? Yes, it is, if it stays sideways. And I talk about, I do option strategies around earnings. They're a little bit more specific on the timing than I'm talking about here. Here I'm saying go outside of 35 days to expiration. Well, if you're doing earnings, I talk about different time frames for that. So check that out. That's not here on this offer here, but you guys can check that out on our platform if you go to protraderstrategies.com. As a matter of fact, that earnings one that John just mentioned, you probably should get that one now and start reviewing that, because we're heading into earnings season again. Lululemon's usually, I can't remember if Lulu's at the end of it or at the beginning of it. It just seems like it's right there in the fuzzy area. Usually you get to the bank earnings, you know you're at the beginning. And we are just leaving the last earnings season and getting ready to cycle into the next earnings season. So check that one out as well. Can you look at my point and see if I'm right? I don't know what your point was there, John. Selling it, I would not. So for instance, I would not sell a Strangle, a straddle, any option strategy for an earnings that is a week down the road or 2 weeks down the road. I would never do that. And I talk about when, where, why I wouldn't do that, when, where, and why I put those on in those earnings videos. So those are a little bit different than just trading, swing trades and stuff like that. Okay. In my mind, they're different setups, different timing, straight locations in some regards, and stuff like that. Okay. All right, that's all I got then. If you guys don't have any other questions, I'll stick around for a little bit longer if anybody else wants to do anything else over there in the comments section. So, oh, I already answered it. Thanks, appreciate that. So one other thing, make sure you subscribe so you get notifications when we're doing videos. The bell right next to it, really important if you want to catch me when I'm coming on live to talk about the markets during markets, so you get live action. Make sure you hit that bell. Feed those bots. Hit that like button. Get me those bots running around and crawling all over the internet looking for other traders like us, all right? And I will circle back around, so if you are watching this on tape delay, I'm trying to make sure even the folks that haven't been able to watch this right now, I circle back every a couple of days, and then I even circle back a month later and make sure everybody is clear of concept. So comment, feel free to comment, even if it is tape delay for you folks. I'll try and make sure you're still involved. All right, that's it. Last thing though is, if you can't take that, take it easy. I nailed that one. Bye for now.